Good morning and welcome. I'm Anita, Hawser, Europe editor at The Banker, and I'm joined by José Minaya, CEO at Nuveen, Mark Newman, President and CEO at Chemours, and Blake Hutcheson, President and CEO at OMERS. Thank you for joining us. And what a challenging decade it's been so far. Previously mentioned, obviously, of a global pandemic, followed by supply chain shocks, followed by a war in Ukraine, then a sort of ensuing energy shock and some of the highest inflation that we've seen in decades. As Wellbeck President Ajay Banga recently told our editor, the bad news has gathered some steam. To top it all off, the global economy is also undergoing two fundamentally different transitions. One is driven by the rapid pace of technological change, the rapid adoption of AI, which has been accelerated in the wake of the pandemic. And we're also, most countries are grappling with the transition to a lower carbon, greener and more inclusive economy. So given these transformational changes, are we starting to see some form of reboot or relaunch of the economy? Are beacons of hope emerging, or are we still treading water? And I'm going to start with Blake all the way over on the end there, because I know you had a pretty good net investment return for the first 6 months of this year of a sort of gain of 3.8 billion. Doesn't sound to me like you're treading water, but can you see safe port ahead, or are you still navigating some choppy waters?
First of all, thank you, Anita. I'm a Canadian. I run OMERS pension plan. We have about 130 billion of equity, about 250 billion of AUM, investing all around the world, including this great nation. I brought my bride with me. We're going to do our level best to help your economy in the next few days. Nice to be in Paris and nice to be asked to be here. Yeah, listen, I think you have to find a way to walk between the raindrops. We've got enough of a portfolio and enough of a nimble approach to this book that there are going to be asset classes that are suffering, for sure, given all of the headwinds you mentioned. But there are also opportunities in every market. And, everybody says it's different this time. Yeah, the elements are different this time. You described some of them. Inflation's high. The cost of money is going to stay high. You see it with your customers everywhere, at the gas tank, at the grocery store, paying their mortgages. It's a difficult time. That does stultify economies. And at the same time, you have to be optimistic. You have to say, okay, where are the opportunities? So when the cost of money is so high, we've put about $15 or $20 billion into private credit in the last year, taking it out of our other asset classes, particularly equities, and we're getting 8, 9, 10, 11% on that opportunity. It's the best opportunity I've seen in 30 years to get equity returns without taking equity risks. And there are certain of our real estate asset classes that are totally risk on. So we're finding ways to find a safe port there. And so I don't think anything's homogeneous. I think there are places where we can do great. There are places where we have to hold the wagon train. And yes, it's going to be choppy waters ahead. Welcome to the real world. I've been investing for 35 years. It's never been otherwise. Some are a little higher, some are a little lower, but you got to find a way.
And in talking of choppy waters, José, I know you said in your client letter in January this year that you expect the market volatility to continue until the end of your career. So how are you? Do you see a safe port ahead? It doesn't sound like you do.
No, look, I think the same. I don't see any new trends coming out of the pandemic, right? What we saw was everything being accelerated. If I go back to even what was in our letters back in 2019, 2018, we kept saying, look, returns are likely going to be lower than they were in the previous decade. We know rates are low. Guess what? They're likely to rise at some point. You haven't seen inflation in almost 2 decades. Guess what? Are you protected against that? Have you thought about that in your portfolio? We've gone from what was largely a academic discussion, and in those conversations, people understood that, and they got it, yet you still had markets that were largely just going up no matter what you invested in, and it was easier to go to something that was low fee, it was easier to go to something that was a lot more liquid. So that conversation, I'm not surprised Blake's returns at OMERS are what they are, because I think firms like his understood the need of the right portfolio diversification, alternatives, private credit, private equity, infrastructure, these things that have very attractive correlation benefits. And I don't think that's where the everyday investor today, a lot of pension plans, are well under allocated to that. Well, here we are. You've gone from what is a academic discussion that everybody understands quickly to one of urgency to where we are today. And that to me is, as we look forward, yeah, we are going to be in uncertain times for the foreseeable future. I think the economy and where we are has largely done pretty well. And policymakers, it seems like we may be headed to a soft landing, yet those uncertainties are forever there. We live in a much more global world. You pick a corner of the world, there's some conflict going on. Any of these things, if something blinks, you're going to drive volatility. But from my perspective, it's always been, I always say, people ask me the question, what keeps you up at night? And it's always that we blink. And what I mean by that, every single pre-Brexit, pre the election in the US for Trump, all these things, we wrote memos talking about what we would do, but we all said this will never happen. And every now and then you got close to blinking saying, oh, yeah, things have changed. It all goes back to the fundamentals of what you do in your portfolios. And again, when you hear a lot about portfolio diversification, to me, it's not just stocks and bonds, it's how well diversified you are across alternatives as well.
Mark, I mean, you're sort of representing the industrial complex here on the panel. What gives you hope that things are turning a corner?
Well, first of all, Anita, thanks. It's great to be here in Paris. Let me start by saying that it's probably less rosy in the industrial complex, and depending on where you are in the world, you know, it varies. What gives me hope, though, is obviously we've been through a period of, you know, very rapid adjustments in interest rates. Obviously, the view is inflation will normalize, rates will come down, maybe they're not going back to where they were, and, you know, the demand cycle will restart. So in a lot of the more cyclical parts of our business, you know, volumes are off double digits this year. But it's a tale of two cities. In a lot of the work we're doing with products that service either the energy transition or the semicon industry, we're sold out. We're sold out on Nafion membranes for hydrogen. So we're sold out on Teflon PFA for the semicon fabs. So it's really a tale of two cities. And what gives me hope about where we're sailing to is, one, a more normalized demand across the entire portfolio, and two, the more rapid adoption, as we heard earlier, of new technologies and embracing material science in the energy transition, in semicon, in more sustainable thermal management.
It doesn't sound like you guys are losing any sleep. Is there anything keeping you awake at night, or any single thing that's worrying you?
Well, I have a Great Dane that sleeps in my bed beside my wife and I, and so she keeps us up quite regularly. Other than that, I sleep pretty well. No, the things that keep me up at night are never a transaction, and they're never what's around the corner from the economy. And because we're a long-term investor, they usually aren't a general election, because I want to see through 4-year cycles, and I want to believe that, to me, a quarter is not 3 months, it's 25 years. And so I try not to I read the papers like all of you. There we go. See, that keeps me up at night. They turned my mic off. And so, no, and so the things that keep me up at night, generally speaking, are people issues, because human beings matter, whether they're your counterparty or somebody that works with you. And the thing that's affecting the pension plan world today is this whole debate that governments are having, that is, maybe the pension plans can start to solve our legislative and social issues, and they're putting their arm around their pension plans and saying maybe you ought to go invest here or go invest there, and they're trying to use this as a bit of a tool of the state. It's happening in Canada, it's happening all over the world, and it's kind of a mug's game, because the truth is, our pension fund money, it belongs to 600,000 members who are hardworking Ontarians in Canada, and it's not the state's money. And as a fiduciary, my positive obligation is to invest on a risk-adjusted basis to get the returns that I need to get to pay the pension. And that's my fiduciary duty. In fact, it's my legal obligation. And so when governments weigh in and say, you ought to be spending a lot more money in infrastructure, even if it's at subpar returns, or go solve the global issues around ESG, the short answer is I can't do it. I'm not paid to have a heart. I have to do what's in the best interest of the plan. It just so happens that many of those things you can capture tailwinds and make great returns for your members, but it can't be state run. So the only thing from a policy perspective, Anita, that does cause me concern is that increasing debate. At the end of the day, I think there's a win-win solution. We want to invest in great infrastructure. We want to invest and get behind great government policy. And when that works for us and it works for the state, that's okay. But it has to be a two-way street.
I have like two mantras I always pitch to our investment staff, right? One is this 80-20 rule around 80% of the stuff out there is noise. Focus on the things that you can control, that 20%, and being able to be focused on what we can control versus what we can't control is going to be a much more efficient way to manage our portfolio. And then the other thing is you have to be, I think good investors are extremely good at knowing what they don't know. And there is an environment out there where I always say, if I walk out on our trading floor, if I go out and across our portfolio managers and say, how many people were really in a professional environment the last time we were in an inflationary environment? So there's things going on today in our economy, geopolitically, that a lot of the folks, a lot of the professionals I have in my firm have never really lived through. They might have read about it in history books and things like that, but they haven't. So I think those are the moments where you focus on the fundamentals, and then you make sure you're really smart at knowing what you don't know so that you're better educated.
Yeah, in the industrial complex, I would say the biggest challenge we have is the interface between our desire to expand capacity to meet the growing needs of the energy transition, advanced electronics on the one hand, and regulation on the other hand. One of the divides that we need to bridge is there's a lot of public sentiment around decarbonization, the climate, but then the very regulations designed to protect the public are preventing those investments from happening at the pace that the market is actually demanding.
Yeah, we'll hopefully touch on regulation later, but I want to sort of have a better idea from all of you of how you see ESG and sustainability as an opportunity to reboot the economy and to maybe introduce a kind of new economic order. I mean, José, I know you've spoken a lot in public about financial inclusion and financial well-being. I mean, does this sort of ESG and sustainability debate present an opportunity to finally move to a more inclusive economy? Do you see signs already of that emerging?
I think it's a tremendous opportunity. We've been a big focus in our investment process on ESG for 5 decades now. And I always say it's a double bottom line issue and one that you're seeing accelerate today. I think it's very interesting in the U.S. where this has become very politicized, right? You've got red states, blue states, and it's been talked about in the U.S. in a way of like, okay, this is now a headwind to ESG. It's a tailwind. Because I spent the last 10 years in being asked, is ESG real? Are people really buying into this? And I would always say, you will know when regulators show up and the politicians wake up. Why? Because in our world, whenever money is really in motion, that's exactly what happens. And what you're seeing today, really around the globe, is regulators are showing up. In the U.S., it's fines. In Europe, SFRD and things. That's a good thing in that it's providing the right transparency and guidelines to invest. What's not going to go away are the risks that are inherent in climate change. What's not going to go away are client demands. And the opportunity is there. And these are still somewhat, I think about the money we make investing in renewable infrastructure, which is almost 2x the returns we would get in a core infrastructure. Yet the risk, I would argue, are lower. So these opportunities, they're out there. And now that money is genuinely in motion, you're seeing a lot more activity with the regulators. You're seeing more activity out there with policymakers, and there's risk and disruption with that. But that's part of every cycle.
And Mark, also there's a resource challenge here. You've touched on it, but could you talk, I mean, there's a race for these sort of critical minerals and resources.
So I think of ESG as a tailwind overall. It's so exciting to be working on new membranes for green hydrogen. We announced earlier this year a new plant here in France. We worked extensively and cooperatively with the French government and to bring that online. So we're not talking about jobs somewhere else. We're talking about jobs here. We've announced a new immersion cooling fluid for data centers. So because there's a huge drive to make data centers more sustainable. So I view the ESG as a huge tailwind from a product perspective, and also an opportunity for Chemours to demonstrate environmental leadership in the way we manufacture these compounds. So yes, there are challenges. I would say the biggest challenge is bringing enough capacity online to meet the value chain needs and then to drive down the cost curve in these new emerging technologies. So that's the role of the chemical industry. That's the role of Chemours, and it's one that we're very excited about.
I mean, surely it's also going to impact your investment strategy and sort of business models. Like, can you give us a sort of insight into how it impacts how you're looking at investments and the companies you invested in, the kind of conversations you're having with them?
For sure. Well, I think North America is way behind this part of the world in this area. Acknowledging the reality, and B, getting their businesses behind it. So I think we can learn a lot from decisions you're taking on this side of the Atlantic. And the truth is, is this going to, in and of itself, kickstart the economy? No, it's a piece of the orchestra. Are we in a recession for a period of time in most countries around the world, 200 or so? We will be. I think it's a slow climb out. And it's largely driven by the cost of funds, which is hurting your margins, which is hurting most people's margins in life. And when demand shrinks and supply chains are tight, fundamentals slip, and economies are slow coming out. So I think we should acknowledge that. I think in terms of ESG itself, it is to us a tailwind too. I mean, and any CEO, and many of you are, all of you are in leadership positions, if you ignore this, you ignore it at your peril. Your board's asking the question, your customers are asking the question, your employees are asking the question. And so if you don't get in the game, you've missed what leadership's all about. And I can give you one really good example, Anita. We've got a company called Oxford Properties. And we took it from about a $15 billion business in 2010 to about an $85 billion business today. It's been averaging 11% returns. And it's probably won 300 awards around the world for being, if not a leader, but the leader in everything we do from a climate change perspective, including it just built the first carbon net zero building in North America, which is a model to the world. Everybody said it's a risk. Maybe. It was a 700,000 square foot building. We're 92% leased, above pro forma rents. Why? Because our customers want it, our employees want it, our members want it. By the way, it's better for the planet. And by the way, it's a product that is a model as to how to do things. And so that one piece of our platform, Oxford, is really a template for me to do the same thing in infrastructure, do the same thing in private equity, do the same thing across our entire organization. And in my view, that's part of leadership, and it's a part of the growth for the economy, but it's just a piece of the fabric.
But how do you sort of navigate this sort of what's happening, what we're seeing now, happening politically with a sort of a backlash, or some people have called it a green lash, and we've also sort of seen a clean energy sell-off, as well as some of those sort of renewable stocks have been hit by high inflation. So does that sort of make you backtrack, or do you just keep steamrolling ahead with your strategy?
I think what's really critical, as Blake mentioned, is that you can reconcile great ESG performance with great business performance. And I don't think the two are mutually exclusive. The question we always ask ourselves is this inherently good for the business long term versus am I doing something because it's a popular social cause? And so I think if you approach ESG through the lens of sustainable business for all stakeholders, shareholders, employees, communities in which you operate, that's the right approach.
But I also just make a real distinction here where, because you hear a lot about the backlash. The backlash has been around language, by the way, because I will tell you the backlash of you seeing firms retrench. The only thing that they've done is changed how they talk about it. If you really think about what they're investing in, not investing in, if you go underneath and look at these firms, they're not doing anything different. Right. There was a time where because stakeholders are asking, because clients were asking, employees were asking, board members, everyone, there's very few companies you go to their website, you're not going to see something about ESG on there. And that was a response to your stakeholders are asking about this. It was easy for a while to talk about this. With a lot of energy and a lot of hope. Again, what's happened now is money's really moving. So regulators are coming in, and the U.S., you saw this, the SEC has given a lot of fines for saying you went too far in what you said. And in other cases, states and governments are saying, well, wait a minute, what are you really doing here? Even though they weren't investing in some of these sectors or divesting, they were saying these things, and now they've had to curb back their language. But what they're actually doing hasn't really changed.
And also there must be the challenge of the fact that the data supporting a lot of investments around ESG and sustainability is not really trusted. So how do you deal with that if we are moving to this sort of new economic order driven by transformations such as ESG? What happens if you can't trust the data, Blake?
Well, I'll take one step back and say, in business, common sense prevails. And you may get heat to spend a little more here or spend a little less there. We're told to often by certain groups, you should categorically dispose of every asset you have in oil and gas in the country of Canada. It happens to be those two products are contributing about 10% of what buoys the Canadian dollar up in the basket of goods that make up the Canadian dollar. And in many pockets in Canada, it would be anti-Canadian for one of the 5 biggest investors in the country to categorically divest of those assets. And by the way, they happen to be some of the best transition, best run businesses in the world, and they're helping us solve this greater issue from a society, because the last time I checked, ozone doesn't stop at a border, and Canada's a solution, not a problem. So I listened to that, divest, no, we won't invest. We can actually influence those areas. We can make them better. They're great transition companies. They help the country. They help our country, help other countries. So when I hear it, I just say, let's have common sense prevail. And usually it does prevail. In terms of the standards, bring them on. Like, we all have to get better. There's nothing that we look at today that we don't say we should embrace. There are I think we should get the alphabet soup right. There are a lot of alphabets out there of people trying to create this standard, this organization, that organization. The better we can collectively talk as nation states and major investors around the world, the better we can tackle those issues and get the standards right. But what gets measured gets noticed, and what gets noticed gets people compensated properly to be aligned. So I'm not afraid of that. We embrace it. We're part of it. And yeah, there's a lot of data that's mythological at this point. So let's just keep getting better so we know what we're dealing with.
And by the way, to Blake's point, that whole bring it on, that is progress. Like, I could tell you today, the data is very poor. I always use the example to private real estate. You go back 100 years, the only people who owned private real estate were wealthy people or companies that needed to put people in a building. Today, any one of us can go to a broker and get exposure to real estate. And by the way, they'll give you mounds of research and information that didn't exist before. Again, the whole tailwinds where money is actually emotion. SFRD rules, these things, all they do are pushing transparency and better information so that more money can flow appropriately.
Speaking of better information, do you think that we need a new measure, a new sort of measure of economic growth There is a debate, and it's been going on for a while, about whether GDP is still the best measure of growth. It doesn't really distinguish between good and bad growth, or depletion of resources, or environmental degradation. We're here at the OECD building, they have their Better Life Index, the UN has the Human Development Index, which, and these look at criteria such as wellness, employment, air pollution, and water quality. Do we need some new economic indicators?
Well, I would pause or be very concerned around good GDP versus bad GDP and who determines that. I serve our clients. I always say we serve all the professors and faculty and staff across universities in the U.S. and I can't go to the person working the cafeteria line and say, I'm taking $100 out of your check because I'm going to go make the world a better place. That is not my fiduciary duty. That being said, I view this as still there's only one GDP, and there's one where it says what is the one that best impacts the world. We think these things are tied together. If you invest irresponsibly, you're going to hurt the integrity of those assets, and returns are going to go down. But I personally would pause at really trying to identify good GDP versus bad GDP.
And to bring that to a company level, I'm sure our shareholders will be interested in us continuing to grow and increase profits, but they're also interested in our ESG profile. So I think measuring both, to me, is the right answer. And listen, we have been very focused on a clear corporate sustainability reporting structure, drives a lot of transparency, shows the good, the bad, and the ugly. And it shows our quest to improve over time. Clearly, I think there's a role for regulators to drive more standardization in what is reported and how it's measured. And then the last point I'd make is the advances in technology. We're using a lot of data capture now to actually improve the emissions footprint of our assets. So, a lot of the data capabilities that we're gaining in society more broadly can actually help in this quest to measure the right things reliably.
I think this is not a new debate. Bobby Kennedy said in 1968, when running for president, GDP measures everything short except the things that matter most in life. Mm-hmm. And that was a long time ago. And when I factor, and when I see GDP numbers posted in many parts around the world, including China, by the way, I don't believe them. I know directionally they help me make decisions, but they are a single piece of a very complicated investment strategy where we dissect thousands of not data points alone, but trends and analysis. And I think the one that, Anita, would inspire me is particularly for infrastructure, is what if we could get together and measure return on society as opposed to return on equity? What if you could take an infrastructure asset? What if there was an institute that was run by a great series of universities from your country and my country and these gentlemen's country that said, why don't we get together and say, how can we actually look at every infrastructure project, analyze what the spend is, or put better, what the investment is, and where the returns are notable in terms of, new job generation, in terms of what it does to transportation flow, in terms of what it does to all aspects of society. Because I know when I buy, and we've got $30 billion in infrastructure, I look at my ROE, I look at my ROI, I look at what we're doing it for, I look at ideal concession, long-term investments. We've got a great book around the world. It's generated 10% for decades. But what if I actually could have an overlay with a standard the same way as you'd have for accounting practices here, there, and anywhere that says that's a return on society. Governments can't argue with it. I can't argue with it. I think we'd prioritize much better by city, by nation, what projects should get funded. I think investors could get excited about it when there's a standard that we all accept. Those are some of the things I dream about. I'm not necessarily debating the definition of GDP.
Okay. We'll wait and see if that return on society emerges.
That's my challenge. There you go. There's an idea.
Let's move on to technology, because in addition to ESG, one of the big drivers of transformation in the economy is technology. And, experts are now predicting that quantum computing may be not that far off as we thought it was initially. And some tech companies are also predicting that we're likely to see human-level artificial general intelligence this decade. So what does all of this mean from an economic perspective? Will artificial intelligence have a transformative impact on the economy? Mark, I know that Chemours talks a lot about 5G, AI, autonomous robots, and how they're sort of a cloudburst of innovation. But what's their economic impact going to be?
So material science and the chemical industry is a key part of driving the digital revolution and the energy transition. And Chemours is really leaning into that. As I was telling you earlier, we just announced earlier this year a new immersion cooling fluid that reduces the data center energy cooling requirements by 90%. So think of the energy reduction of 90%, and also virtually eliminates the need for water. ChatGPT, by the way, required 1.7 billion gallons of water to develop that technology. So there's a lot of water and energy use happening in data centers. So we're very excited on the product side about what we can do to enable a more sustainable data infrastructure. By the way, we also make fluoropolymers that go into every chip fab. So we're serving both the manufacture of chips as well as how we keep chips cool when they're in use. We're also very excited about how we use this technology, whether it's generative AI on new chemistry development or machine learning in running our plants better, including reducing emissions at our plants. So I think the technology here has a lot of potential. Clearly, it has to be regulated well, but I just want to stop by saying, hey, it's super exciting from a material science chemistry perspective to be enabling this technology on the one hand, and on the other hand, using it in our manufacturing to drive better, more responsible manufacturing all around the world, but especially here in Europe and in the US.
And Blake and Jose, are you just as excited? I mean, is there the opportunity to use this technology to make better investment decisions?
Yeah, well, one, I think, look, AI has been around for a while, and I can go back 6-7 years ago being asked the question, do you think AI is going to be disruptive to the asset management industry? And I said massively. Yet I couldn't tell you if it's next year or 20 years from now. Clearly, that more recently is accelerating, right? And it's one thing where I'm very challenged, again, in how we think about AI. And it's largely because you could see the benefits, but from a business perspective, you're not necessarily tying the revenues to it yet. So on one end, I'm like, okay, do I invest $1 billion in our business to kind of build better AI, to make better investment decisions or better research? Sure, but at the end of the day, how am I going to see that in my margins and how I deploy that capital? So we're doing a lot of partnering with people, trying to lean into this because we don't know how quickly this wave is going to come in. As portfolio managers, a lot of the portfolio companies and securities and companies that we own are talking about how AI is going to change their business, yet you're seeing this and going, well, how is that really going to show up through your P&L as well? So I think AI is going to be a game changer. It's going to be very disruptive in many good ways and in some bad ways and challenges. But again, I think the timing of all this, to me, is very hard to determine as to kind of when that impact happens. And that matters because this all comes down to how you deploy capital and resources.
Yeah, Jose and I were in London yesterday. There was a economic summit for a group about this size hosted by the Prime Minister, with the presence of the King and cabinet ministers and world leaders. It was an amazing collection of people. there were 12 buses to go to Buckingham Palace. I was in bus 8, so I'm not putting myself in that same group because I knew where I stack ranked against some of the great leaders in the world. But they had a 6-hour agenda, and an hour and a half was on AI. So everybody is focused on this very issue. The COO of Google, who happened to speak, said their organization is more excited today about this than anything that they've tackled in the last 10 years. So to the point of excitement, when they're one of the most innovative companies in the world, that'll tell you, how people are embracing it. Listen, it's, you have, again, I run such a far-flung empire with businesses and real estate and infrastructure and equity markets and capital markets. I have to pick my spots. There are places where shame on us if we don't lead, and there are other places where we should take a back seat. We are not in the business. I think it was Drucker that said there's nothing so wasteful as doing something elegant that should never be done at all. I don't want our people to be pioneers in certain of our businesses. In this space, we should sit back and watch, and we'll see mammals adapt a lot slower than these computers, and so I'll just sit and watch. There are other areas where we have to jump through the front door, get all over it, including we have a nuclear plant in Canada, largest one in the world, and it provides 32% of the electricity to the province of Ontario, 20 million people. And on that topic, to your point, from a manufacturing standpoint, just understanding the useful life of every seal that we have in our system and when it might expire and when it won't expire and things of that nature, it is gold to us. And so I think it depends on the business. It depends on whether you should wait or lead. I'm also chair of a high school in Canada, and it's really interesting. Inside of a week they said, okay, we have to open it up to our students because you can't tell them to keep their calculators at home, and you can't tell them to keep this tool at home. Now, how you govern that and how you surveil that and how you make sure people are still thinking, it's a huge issue. And that goes to every aspect of business, to the regulation and all the things José said. There's some great and some really, really frightening things that come out of all this.
I mean, there's also a lot of movement around tokenization, digital assets. José, do you think that could democratize investment?
Oh, I think it can, and I think it will. And again, this goes back to a comment I made earlier around what was an academic discussion is now urgency, right? You're seeing it in the U.S. with the passage of the Secure Income Act, where you're moving into having your DC or your 401k retirement plans the ability to have an annuity or guaranteed income. And I say that because they're trying to solve this issue for most of the folks today are invested in index funds, stocks and bonds, and the world's going to realize this is not going to solve the need for retirement. In the U.S. alone, I think it's more than 40% of the population is not going to be able to retire. So it's a real crisis. Yet, again, if you look at OMERS returns, they have the ability, they're a sophisticated investor, that they're able to diversify their portfolio in a way where you say, well, how is it that you guys are doing this way and there's this much volatility? The everyday investor can't. And a lot of this, you're seeing this now in the UK as well, where they're talking about how do we get more access to the everyday investors to a broader set of portfolio options, right? It's portfolio theory 101. The more options you have, the better you should do in the end. And a lot of this has not been a push of urgency because, again, you've had better of 2 decades with just returns going up. Now, governments, legislation, they're needing to respond to a better answer around how we help people retire with dignity.
Anita, if I could just piggyback on this
briefly
point.
We have 10 minutes, under 10 minutes.
We have seen a lot more empowerment of our frontline workers with digital tools. So in the good old days, the engineer said, this is how the plant operates, and the frontline operator just basically followed the manual. Today, leveraging data, that same operator can say, no, the plant actually runs better this way, and I can show you the data. And so when you talk about democratization from digital, it's way more pervasive than just, tokens and Bitcoin.
Sure.
It has to do with, getting frontline workers and broader society who are able to understand the data and interpret the data to be more involved in decision making.
I want to move now. We've got under 10 minutes, but just briefly want to look at regulation because, is regulation likely to play a role in shaping this sort of new economic order? Is it going to be a catalyst or is it about preserving the status quo? A lot of people have obviously referred to the Inflation Reduction Act in the US as being catalytic. Do we need more, although obviously, depending on the elections next year, it may not be so catalytic. But I'm just sort of wondering, do we need to see more policies like this in order to sort of drive this sort of economic reboot?
Well, I'm hard-pressed to call regulation a catalyst, but I will say it is a necessity. And typically where regulation shows up is where you have a lot more volatility, right? And as, again, money's in motion, you're seeing regulators coming into ESG. You saw, the two areas where I track regulation the most today is you saw this in the U.S. with the regional banks and the crisis we had there. What we know coming out of that is that regulation is going to be stronger going forward. That typically is going to lead to less credit being offered. That is going to have an impact the economy. And I think the burden is on us, on business and operations, together with regulators, to have that dialogue. You saw this with the SFRD rules coming in Europe. It was going one way. A lot of us kind of talked up and said, this is confusing. This should be changed. There was a pause. They'll come back to the table. So I look at this and say, with regulators, I facetiously say, look, they get it wrong 100% of the time. The question is, how quickly can they course correct? And that has a lot to do with how we are engaged in that conversation to execute as quickly as possible.
Mark, I know you're not a fan of regulators, particularly around the issue of PSAF, the chemicals which are resistant to oil and water, but also have environmental and health impacts.
Yeah, so, there's been a lot of focus on PFAS compounds globally. What we really aspire to see is coherent regulation. So you cannot be on the one hand saying, we want net zero, we want Repower EU, we want IRA, and on the other hand, like we have in the recently published REACH dossier, a complete ban of the chemistry that gets you there. I mean, the right hand and the left hand need to bridge the divide in this case. What we could also benefit from is more coherent regulation between, say, Europe and the US and other developed economies like Japan, for example. So we're trying to drive a semicon value chain and de-risk it geopolitically from China on the one hand, but then Europe is going in a very different direction on the REACH dossier than Japan wants to go and the US wants to go. So I think regulation is actually inhibiting the energy transition and the adoption of a lot of new technologies like we just talked about in digital, where chip manufacturing is essential to all of this. We don't have any of this stuff without chip fabrications, and you don't have that without Chemours chemistry.
I'll be very brief. I think there's that old expression, what's the most contradictory statement you've ever heard? And it is, hi, I'm here from the government and I'm here to help. And it might have been invented in this country. I can't recall. I don't know the translation. But it's certainly true of our country. And so I think regulation in and of itself, because you just don't have commercial players at the table, and you have these things called elections and coups that can throw you off, it's hard to get comfortable with any of it. I think collaboration is essential, more so than regulation, and particularly as we all put a target zero line in the sand by 2050, and who's kidding who? There isn't a CEO you can point to on the planet who actually really knows the linear path to get there. It is going to have to involve new innovation. It's going to have to involve new collaboration. It's going to involve governments. It's going to involve nation to nation and asset to asset and investor to investor. And so that only happens through trust and collaboration. Regulation is, for the most part in my career, a problem, not a solution.
And So in sort of thinking about this new economic order, I think do you think there's specific regulations that you're most concerned about, or one specifically that you think are needed to help reboot the economy? Mark?
Well, for me and for the chemical industry, it really is around how new chemistries are brought to market that the world needs to drive the energy transition, and the clarity of regulation that then allows you to actually permit and build a facility. We're building a facility here in France, as I said earlier, to build Nafion membranes for electrolyzers for green hydrogen on the one hand, but on the other hand, the EU is purporting or advancing a dossier to ban that chemistry. So it's the coordination that needs to really happen.
You know, my fear, especially coming from the U.S. and regulation, is that, look, in the U.S. today, you have a very polarized, political, right now, the left and the right, they're extreme views, yet they're a small minority of the overall population. And I worry that public sentiment, I worry that extreme views on the left or extreme views on the right filter into the regulatory construct versus a collaborative discussion between regulators and business.
And to help us think, in the sort of final minutes of this session, to rethink about, or just think about what this sort of new reboot of the economy might look like, I'd like each of our panelists to sort of give us an idea of, from their perspective, what they think it will look like, even if you believe in this new reboot, and how will it be different from what's come before? Blake, let's start with you.
Well, economies are so complex and multi-layered, and what's happening right now is margins are shrinking. Labor costs are up, cost of money is up. Here's a living example. Your sales, not for all your divisions, but certain divisions are down. When margins shrink, you don't reinvest. When you don't reinvest, capital programs don't get booted, and everything comes to a slower place. And so I think we just need to start believing in tomorrow. I think we need to believe that there's a future. I think we need to find ways and great companies will figure this out. And there's a massive bifurcation between how well great companies do and great assets do, and how poorly weak companies and weak assets are going to be in this kind of an environment. So I'm a firm believer in diversification. If you want to get rich, put all your chips on one square. If you want to stay rich, diversify. You do that by geography. You do that by asset class. You do that by everything you do. I'm a firm believer in quality because quality sees through cycles. And I'll say the most important thing for the future, Anita, is a simple thing. Put the computers away. Put the innovation away. Build trust. I think everything comes down to relationships, personal relationships with your counterparties. It involves steak dinners, great French wine, sitting down with people that you want to grow old with, cutting deals that make sense for the future. And I think that's what's getting lost in this world. And I think it's by far the most important thing to reboot the economy.
We have just under 40 seconds remaining.
Stay focused on your true north. For us, that's creating a better world through the power of our chemistry. That's what we want to do. And
I'll quickly wrap up and just say, look, we're all going to have to do better. And what I mean by that, when things are all flying high, you could throw the proverbial, dart on the dartboard. You're going to have to be better at picking managers. As leaders in companies, you're going to have to be better at picking talent. I think you're going to see a lot of consolidation, a lot of M&A going around, because in an environment where things are more volatile, talent's going to matter. Like doing the right thing, staying disciplined. These things are going to matter more than they did in the previous decades.
Thank you very much. Thanks to our panelists.